Shocking news around Walgreens stock came out today. They're slashing their dividend by 48% from 48 cents to 25 cents. The stock is down around 5%. If you look at the 5-year chart, it's pretty bad. You're talking about a stock that used to trade in the 70s, now at 24. What happened with the dividend? How we could have seen this coming? And then are we considering buying this stock as a discount or value play? Looking at the dividend, they have had annual increases for 49 years in a row. Very impressive. But if you look at this dividend yield, over the past couple of years, the yield has crept up all the way to 9%. So when a stock has a higher dividend yield, some people may think that's good. For me, I'm wondering, why does it have such a high yield? Usually the sweet spot for dividend stocks that are healthy is anywhere from 1 to 4%. And so that's the first telltale sign that maybe something's going on. If you dig into it a little bit more, there's some ratios that you can look at to see, hey, is there some flames? Why is there smoke? And one of them being the payout ratio. Looking at the past 10 years for the payout ratio, it looked fine prior to 2019. Payout ratio was in the 30 to 40% range. Prior to 2015, there's a couple of years where it was 60. But payout ratio basically means that they can take the dividend payment and it's covered by the net income that they're making. Things got a little wonky in 2020, such as Walgreens took a hit. And so a lot of the valuations got out of whack during that year. But after COVID, the problem is they took on a ton of debt to get through that. So they went from operating a net debt to EBITDA ratio of 1 to 2 to now they are fully loaded with debt. So there's less flexibility for the company to deal with problems that they're seeing. And then last year they had a giant litigation payment that caused their net income to be, was it negative $3 billion on a trailing 12-month look. Even without the litigation though, this quarter alone they had a loss. So they went from a company that had small margins, but they were making net income. They were able to pay the dividend no problem. And then if you look at the free cash flow, that's also been shrinking. So not only the net income is going down, but the free cash flow. So the payout ratio with the free cash flow has also skyrocketed. So you have increasing debt. You have the revenues relatively stagnant for the past 5 years. So they're not really able to grow the top line. And then more of their money is going towards this dividend payment. Having the company cut their dividend by 48% makes a lot of sense because they need to have that money around to operate the business or invest in the business to pivot if something's not working. So I get why they're doing it. But for a lot of investors, the reason that they're even touching this thing is because of the dividend and the dividend yield and the fact that they've been paying out for 49 years. Why would that change? I think one lesson is that just because a company continues to pay out a dividend every year doesn't mean it's going to last forever. You have to be looking at the earnings, the free cash flow. What's the payout ratio look like? Are they increasing their debt? It's all about looking at that dividend and asking, is it safe? With Walgreens, there were definitely signs that this may be coming. And the question is, would I buy the stock? No. For me, I'm looking for companies that have revenue growth. It's not a great sign that they cut the dividend by 50%. It's good for the business, and I know why they did it. I would rather see them kind of stabilize and then maybe discuss. Not enough quarters have passed where they're actually profitable again for me to feel safe buying into the stock on the dip. So some people are probably going to try to catch a knife, try to get the bottom of a value play. It's not the type of company I tend to invest in just because I'd rather invest in a growing company at a decent valuation versus trying to scoop up a company that's trying to turn around the ship at a discount and try to catch the bottom. That's just not my style of investing. So yeah, for me, I'm not touching the stock. But let me know in the comments below if you're thinking about taking a nibble in the stock. If you did enjoy watching this video, consider giving this a like, subscribing to Main Street Wolf, where we talk investing, personal finance, all that fun stuff. Thanks guys for watching, and have a great day.